It's IPO season. It's positively raining IPOs. And among them, we recently had a blockbuster. The 6,560 crore rupees listing of Bajaj Housing Finance set multiple records on Tuesday, September 11th. The issue was subscribed 64 times on the final day of bidding, and it attracted bids of nearly 3.23 trillion rupees. That marked the highest ever demand for a maiden share issue in Indian primary market history. The previous record was held by Coal India, which hit the bourses way back in October 2010. The Bajaj Housing IPO also set another record by receiving 8.9 million applications, surpassing the previous record held by Tata Technologies. Of course, another significant point is that the IPO dropped in a month which is the busiest IPO month in 14 years. Could well be 15 actually, if some planned IPOs that are in the news actually fructify. Now, Bajaj Housing. As most of us know, it's a non-deposit taking housing finance company registered with the National Housing Bank since 2015. It has been engaged in mortgage lending since FY18. The company offers financial solutions such as home loans, loans against property, lease rental discounting, and developer financing. According to a recent report from BP Equities, its strategic focus is low-risk and fast-growing home loan customers. As of March 31st, 2024, Bajaj Housing's assets under management, or AUM, were 91,370 crore rupees, reflecting a growth of 31% between FY22 and FY24. 88% of its home loan customers are salaried individuals, and more than 75% of Bajaj's home loan customers come with high CIBIL or credit scores of over 750. Great stuff. But what about the overarching industry assertion that the company is overvalued? Well, data from Trendline shows Bajaj's market cap is 3.5 times that of LIC Housing Finance, for instance, even though LIC's net profit is 2.7 times that of Bajaj Housing. The difference? Bajaj Housing's fundamentals are growing way faster than LIC. But then, what about PNB Housing Finance, whose quarterly profits grew at 24% compared to 4.51% at Bajaj? Despite the higher growth in profits, PNB's market cap is a fifth of Bajaj. So, what explains these massive numbers? What's clicking for Bajaj Housing, and is this run sustainable? Let's find out. It's Tuesday, the 24th of September. I'm your host, Anirban Chaudhary. This is the Morning Brief. First up, ET's banking ace Saloni Shukla. Hi Saloni, very warm welcome to the Morning Brief. So glad you could make time on a Sunday.
Thank you so much, Nirvan. Thank you for having me.
So we are talking about the Bajaj Housing Finance IPO, a record-breaking blockbuster issue as most of us, as all of us know actually.
Yes.
So, just wanted to start by asking you, see, IPO, more than anything else, it's a question of perfect timing, right? The success of an IPO.
Yeah.
So, given two things, given how the housing finance industry is doing right now, and also the performance of Bajaj Housing Finance, how well-timed do you think this IPO was?
So it was an absolute perfect timing, Anirban. And in fact, the company hardly took any time to get permission from SEBI, to get listed. So, that is the strength of the brand that we are talking about. So first things first, see, we are seeing an extreme frenzy in our capital markets right now. And Bajaj came in at a time it was fairly, very well valued. It left money on the table for investors. So that was the big thing. Also, very good parentage and the kind of pristine book that they have maintained. That is what, investors thought was attractive, and the valuation that it got hence. Also, the other aspect is that this has led to a re-rating and, increase in prices for other non-bank lenders, HFCs particularly, because the market is now seeing, the strength of this market, the potential of this market, how housing starved this country is. So, yeah, the timing was perfect, Anirban, but also it left something on the table for investors. And also, the market clearly saw the growth potential for this company.
What is it that you would say sort of differentiates Bajaj Housing Finance, apart from, of course, its parentage, like you
Yeah.
mentioned? What is it that differentiates it from its peers?
Well, the differentiation actually comes from the parentage because the parentage gives it the AAA credit rating that it commands. Because of that AAA credit rating, it is able to raise money in the market at par with banks and Irban. That's a very important point. Because what happens is in this space, mortgage, because of the low risk quality of the book, it's extremely competitive. It's almost at par with banks. And the kind of clientele it has is just like a bank. Okay. So that is why we are looking at the kind of quality that they have maintained. It is just like banks. Banks hardly, have any worry on their mortgage book because it is collateralized. You have the house as a backup. You're lending to extremely good customers. The kind of book also that they have maintained, if you look at their portfolios, they are in the larger ticket size. You could say 70, 75, 80 lakh. That would be the ticket size of their, if you don't look at the average, but the largely the book size. So they are in, the prime segment. That is where they are lending. If you look at other housing finance companies, because of, the low yielding segment, they are trying to exit. So recently we had PNB Housing Finance announce that they will be exiting, the prime. The prime basically is the top category of home loans, and they will be, looking at a lower affordable housing segments. We also had another housing finance company, Godrej, announce that they will be entering the affordable housing segment in the last quarter of this financial year. So we are increasingly seeing housing finance companies gravitate towards, the higher yielding and higher riskier loans, if I can say that. But this particular company has maintained that it wants to, low yielding be at its may. But, it wants to be that particular segment. Look at its, the kind of book that it has. It's offering your normal home loans, that it has loans against property. It has LRDs, which is lease rental discounting, another very low risk product, and developer finance, right? So even if you look at their book, it's pretty diversified. It has almost 58% of housing loans and 10% of loan against property and 19% of lease rental discounting. So that is where it is wanting to differentiate itself. It's a NBFC, it's an HFC which is competing with banks. That is the differentiation comes from when other HFCs are trying to move away from this space, Anirban.
Do you agree with a lot of industry experts who say that it definitely is overvalued?
Absolutely. Without a doubt, it is extremely overvalued. Let's look at this company, okay? It has a book of 1 lakh crore. It has, like I said, near perfect, almost 28 basis points of bad loans is what it has currently. But if you compare it with, the larger names, say, for example, HDFC Bank or say Kotak Mahindra Bank, who are trading around 2 times book or lesser than that, and we are looking at valuations exceeding double or more than double of that. I don't think so that is justified. So what happens in the future, we can't crystal ball gaze at the moment. And, it's trading almost 160 rupees or more than that, at the end of Friday's close, right? There are a lot of numbers throwing around that, maybe 100 rupees is a fair value or 4 times book is a fair value and all those things. But it all depends upon where our capital markets are positioned at the moment. We are looking at record highs, money coming in through mutual funds, SIPs, even normal, markets are seeing increased retail participation, in any good brand company or somebody who leaves money on the table for investors will be lapped up. So that is what it is at the moment. But yes, it's extremely overvalued, and there is obviously caution whether it will correct in the future, whether it will be able to sustain these levels. The jury is still out on what will happen on the valuation it currently commands.
And yet this claim by the management that they want to be the next HDFC corporation, how do you really read that? To me as a layman, it sounds a little overambitious, but you'd be the best judge to tell me. How do you read that?
See, I mean, if you speak to the management, they will, talk about the potential of this market and, how it's already a 30 lakh crore market, and it has India as a housing staff market, and it has huge potential to grow. Obviously, all those points are considered and well taken. The only point I am considering it that they have achieved a certain scale, which is about 1 lakh crore. And then scaling from here onwards should be an easy task because of the kind of branch network they have created, almost more than 200 branches. They also have a very strong brand in Bajaj Finance. Maybe they can tap the branches of Bajaj Finance as well and grow that book. Also, remember with the exit, or maybe say the HDFC and HDFC Bank and HDFC Corp merger, that space is sort of, I can't say vacated, but there is a space for another HFC, NBFC to grow and take that space. So if they're able to, grow that book and scale that book, it will not be an easy task, because increasingly we are seeing competition build in this space. We are seeing as banks slow down their loans on the unsecured side, they will want to grow their MSME and their, home loan book. So that is one challenge the likes of Bajaj Housing Finance could face. But yes, one thing has to be considered, that there is presently space in the market for somebody to take that space which has been vacated post the merger of HDFC Bank and HDFC Corp. They have, a strong background. They have created a very, strong book. How to scale on from here onwards in this, amid this increased competition, is something that we will have to see, Anirban.
So how should investors take this frenzy? To understand this, I spoke to Jignesh Shial, Director Research and Head of BFSI at Incred Capital. Let's move to that conversation. Jignesh, hi, very warm welcome to the Morning Brief. So glad you could make time.
Thank you. Thank you so much. And thanks for inviting me as well.
So we are talking about Bajaj Housing Finance, somewhat blockbuster of an IPO. And what we saw was a total frenzy. Now, your report said that valuations for the company are a little over 3x. It listed at more than 5x. And we've seen a fall also after that. There's been some sort of a correction in the last 2-3 days. So Jignesh, what would you advise investors at this point?
Look, I guess this is a very good franchise run by very, efficient management. The book is able to grow. I mean, they are able to grow this book, at 30% kind of a CAGR. That's quite possible considering the kind of penetration they have it, as well as the kind of capital adequacy that is already been built in. It's a conservative guys. I mean, they already have a pretty good track record. So I think it's somebody is looking for a longer tenure. It's definitely a stock to own for. And housing finance is a segment which is going to stay for a quite longer period of time. It's something which is underpenetrated market. India is a quite underpenetrated market. So we are pretty positive on the space altogether. Having said that, we believe that valuations still might see a kind of there is a euphoria in the market right now as far as IPO listings are concerned. And I think overall, if somebody is looking for mid to long term, it's a good stock to own. But I think still there could be some consolidation or price correction is possible, at least in near term, considering that the valuations are already extremely stretched.
How much would you think will be the price correction?
It's very difficult to predict that how much further correction can happen, but I will be more comfortable at somewhere around between 4.5 times price to book at the stretch at the highest, considering mid-teens kind of ROEs and 2.5% kind of an ROAs. I think it's pretty competitive markets altogether. So I think I'll be more comfortable somewhere between 4.5 times price to book on a higher side, to be very honest.
Understood.
Yeah.
So also, talking about Bajaj, do you think that it'll be able to replicate what it did in the consumer durable space, in its mortgage space as well?
Look, I guess they both are completely different, business altogether. Durable financing is more exclusive kind of a product, which it's very difficult to replicate so easily. And that's the reason why they still remains the market leader. Whereas in case of housing finance, it's tried and tested model. Most of the large private sector banks as well as PSU banks, a couple of NBFCs, HFCs are already there in this business. It's very difficult to do something very different in this particular space. Having said that, managing the growth and as well as a superior asset quality and then improving the ROAs, that is something I think they can definitely do it well. And obviously having a Bajaj pedigree and a very excellent kind of promoter and management background, I think that is something that can give them the consistency, and that's what will give them a kind of a premium valuations. That is something is possible that they grow at a similar pace at what Bajaj has done and all. I mean, the parent Bajaj Finance. But I think some exclusivity that consumer durable financing has it, which Bajaj enjoys, I think that is missing out.
Also, talk about competition. We are seeing a lot of competition from banks, and other mortgage lenders. How do you see Bajaj's sustainable growth in such a scenario in the near future?
Look, so basically what we have understood, so we spoken to the people on the ground, customers as well. We have done our channel checks on the ground as well. And what we have realized that the turnaround time, what Bajaj offers is generally, not only Bajaj Housing, even Bajaj Finance and all, they're the fastest among the lot. It's completely technology driven process. It's pretty easy for person to understand, and they are generally being a pushy guys. So that way, they're consistent in delivering and managing the growth. I think that is what is visible in case of Bajaj Housing as well. If that stays intact, I think growth as well as managing the profitability won't be a challenge. More importantly, they are having a decent presence across not only in metros and tier 1, in tier 2, tier 3 cities as well, where basically customer needs more of hand-holding, more of support from the lenders altogether. I think here NBFCs generally have an upper hand compared to banks. I think there also Bajaj Housing will definitely have a better say or better growth compared to a pure tier 1 or metros where the competitions are generally pretty much stiff.
But wouldn't the volatility of the real estate sector per se play into whatever estimate one can make about a lender in this space?
Definitely, it makes absolute sense. Whenever the volatility in real estate space happens, there is always an impact which is visible in HFCs. But I think this is more relevant up to tier 1 cities. Tier 2, tier 3, it's more like standalone houses or relatively smaller developer. Even they have also indicated that they have a decent funnel of funding the developer and then getting the first right of doing the housing finance business for their retail customers. I think that will still stay. So wherever there is, not much of a large developer or much of a developer markets are not being involved and self-constructed houses or smaller houses are concerned, I think there are also tier 2, tier 3 cities more belongs to them. I think there the penetrations will still be better despite volatility happening in the developer space. But right now, I think consolidation in developer market has already happened. So I don't see much of a volatility will be there in developer space, at least in near term.
Understood. And finally, how do you read the management's claim that it wants Bajaj Housing Finance to be the next HDFC Corporation?
The promoter pedigree is there. They're one of the finest or excellent promoters that you'll ever see. Their visionaries always had been. But the management quality is also equally good. So it's not completely impossible. But I think HDFC and Bajaj are two completely separate corporate houses altogether, if you will see it that way. And both are having their own uniqueness and the way how they function, how they deliver. I think that will remain intact. But whether Bajaj is good as a house or as a brand, I definitely will agree with that.
That's it for today. You were listening to this episode on The Morning Brief. It was produced by Surohini Jain and sound designed by Indranil Bhattacharjee. Do like, share and subscribe and keep listening to TMB wherever you get your podcasts. Have a good week.